So I'm going to kick this off. We're going to go broad and then maybe narrow a little bit. How do you define impact investing? And is that the term you use?
I'll start out. So we don't really use the term impact investing. We use the term sustainable investing, and we use it really in many ways as a way to distinguish it from ESG. ESG has gotten such a bad name over the last several years, and ultimately we've never really used that as a style of investing. But the way we describe ESG is really the way we look at how some of the big players do it. We'll use I like to use BlackRock as an example because they've got one of the largest ETFs focused on ESG, where they'll take an index, they will layer on top of it some ESG metrics, and they will call it sustainable. But at the end of the day, it's not necessarily sustainable. It is just a less risky version of the original index. One thing to remember is that ESG is about risk on a company. A lot of people out there would tell you that ESG is the risk that is on the world around a company, but actually what ESG measures is what is the environmental risk on that company, what is the social risk on that company, what's the governance risk. So for example, an environmental risk might be if we decided to put a manufacturing plant right here on the beach, there's going to be tremendous amounts of environmental risk because we're in Florida, so you might have a hurricane that comes through. We've got sea level rise that ultimately is going to impact us. So that's a material impact that we can specifically look at from an environmental perspective. Now, to contrast that with sustainable investing, which is what we do, sustainable investing for us is more ground up. It's more about looking at what are the sectors, the industries, et cetera, that are going to lead us into a cleaner, more resource efficient, more resilient, and more equitable economy.
At Community Capital Management, I think you need to have a definition because it's easier to summarize what you're doing. So we call impact investing. We never really use the term ESG. We always felt like this is that broad umbrella and doesn't really touch on the nuances of each individual type of really kind of values-based investing is how we think of it. And what aligns with our clients' values and how do they want to deploy capital. And that can be a myriad. So we have separately managed accounts, and if they come in and say, we want to invest because we want to positively benefit communities, and we want to focus our capital based on place-based investing because this is where I grew up and this is where I made all my money, and I want to drive capital into Alameda, California and New Orleans, and I can do that. At the same time, if I say I really care about affordable housing or I care about environmental issues, we can do that, and they all have positive impacts on society. ESG was this quick and easy term that was overused, and now it's been weaponized for bad, and we really we've always avoided it, but now we avoid it even more because we felt that it wasn't a good enough definition of what really clients are intentionally trying to do with their capital.
Yeah, because ultimately what we've learned is that retail clients, which is specifically what we work with, don't want to have a less bad portfolio. They want to have a portfolio that actually is contributing with solutions to some of our biggest challenges.
And I think the biggest thing to add to that is also they want to make money, right? The goal of their portfolio and the goal for us is we're fiduciaries. We have an obligation. And I really do find it humorous that at the end of the day, the woke style of investing and the commentary that we hear is saying you can't make market rate returns, you can't beat benchmarks, you can't beat indices. And we've been around for 25 years. I think you've been around for over 20 years. We wouldn't be around. Clients wouldn't be allocating capital to us if we weren't able to deliver market rate returns or better while delivering impact at the same time.
And to just sort of extend on that a little bit, I think it's sort of priceless that there are so many politicians who are, very pro-business and anti-regulation, who, when it comes to, maybe things that might impact some of their, campaign contributors, suddenly want to regulate.
That is very interesting. So both of your firms have been investing in this way over 2 decades. Did I hear that right? So if I think back to the history of the space, I think we first had something called SRI, right? Socially responsible investing, anti-sin, or maybe faith-based, which still exists. Then we had this ESG. It sounds like we're about to slay this dragon. We're not going to use this term anymore. So sustainable, impact, values-based. I think we're still struggling maybe with a little bit of an identity crisis as to how to properly talk about this topic, but maybe we'll get into some of the details. Did you want to add anything?
I think when I started, it was socially responsible investing, and I mean, you could sort of get a sense for what it was, but there wasn't a lot to quantify at that point. It was really, socially responsible investing was three things. It was screening, so screening in the types of sectors you wanted, screening out the ones you didn't want. It was shareholder advocacy, which still a lot of firms do. So basically using your proxy to push companies to be better in particular areas like lobbying or transparency or gender diversity or just diversity in general on boards. And then the third is community investing, and that was bringing in firms like CCM to do the community investing side of things. But over the years, that hasn't really reflected what a lot of these firms have been doing. And ESG came in, but it was really just sort of co-opted by the big firms as a way to sort of check a box. And SRI sort of transitioned into sustainable and responsible investing. And what we've really tried to evolve it into, if you will, over the last year or so is sustainable, resilient, and innovation investing. And the reason we add resilient is I live in Asheville, North Carolina, and so I saw some of the effects of a climate-fueled storm hitting deep inland, and saw some of the effects from an infrastructure perspective. We were not prepared for that storm. We didn't have the infrastructure, not just in our, in the way the city was built, but we lost communication. We lost communication for weeks. We unfortunately, or we fortunately were able to get out of town, but we lost communication. We didn't have potable water for 2 months. So it's these kinds of infrastructure things that when I talk about resilience and adaptation, really need to be a part of a sustainable portfolio going forward. Sustainability in general is about not living in a way now so that way our children and grandchildren also aren't able to thrive. So reducing our impact. And then innovation for us is what brings it all together. How can we innovate in a way from a sustainability perspective, from a resilience and adaptation perspective, to both make money like you're talking about, but also be a positive force for change.
So we've had some policy shifts, political shifts. How have you seen the impact on demand from the client perspective in wanting these types of strategies in their portfolios?
We're mostly fixed income. We're about to go into the private credit sector and launch a new product in the next quarter. But what we've really seen is not necessarily a divide. I think what we've seen is a doubling down from those that already invest. It's saying, hey, it's more important now to step up and to continue to deploy capital maybe faster than we had thought, because there may be people that were investing that have now pulled back. At the same time, I think when you start to talk to asset allocators and the gatekeepers, and they want to understand, well, what's the difference between what you do and everyone else, and why do you matter? Or my client would say no, and we say, well, it's not impact, it's not this, it's really at the core is aligning with what your clients care about. And regardless of on what side of the aisle that you're on, there are values that clients care about. And we've even seen, we're in Florida, and when Governor DeSantis went to run, and he came out with he released his website, and anti-woke capitalism, saying, DEI, ESG, all this investing is horrible. Literally 7 days later, he initiated a bill for affordable housing. There was a public-private partnership with tax abatements. And what we do is a lot of what we do is affordable housing and Section 8 properties and investments. And unfortunately, affordable housing, there's not enough units, and it doesn't matter what side of the aisle that you sit on. You would think that a lot of people in South Florida historically were Democrat if they came from Venezuela or Cuba, but they saw what communist societies are. So in reality, they would never vote Democrat. They were always Republican. And there was a lot of surprise, and we saw more of that, which happened in 2016. But they need affordable housing, and we hear it and we see it all the time. So at the end of the day, there's the headlines that catch the news and what everyone sees, but then there's really what comes down to your clients and what they need to deploy capital, and being able to provide them that customized solution is critical. So because we focused on fixed income and private credit, we're able to really preserve capital, give them a steady stream of cash flow, all while directing capital to their specific needs of what they would need. So we have 14 impact themes, from affordable housing to gender lens investing to healthy and sustainable communities and transit-oriented development. And through those different themes, clients can either direct geographically, like I said before, or they can focus on the impact themes and say, here's where we want to deploy capital across the spectrum of different type of positive benefits to society.
So I think the media portrays us from a political perspective of being, this far apart from each other, when the reality is we're really just this far apart. We all want the best for our families. We all want to feel safe. We want to have enough food on our tables. And so when I think about any pressure that we may feel coming, political pressure that we may feel coming, I think about it from that perspective. We still have got a ton of people coming to us asking, can you help us invest sustainably? Because the reality is, because we focus mostly on sustainability and climate change and that kind of stuff, that's not going away. Political pressure is not going to change our climate. And so we need to continue doing what we're doing. When I look back at the first Trump presidency, we actually doubled our business because the clients that we had, or the prospective clients that we had coming in, were saying, hey, we realize that government isn't going to take care of this, at least for the next 4 years. But we want a way to do something, and so we're going to put our money where our mouth is. We're going to align our investments with our values, which is what people did, and which is what we're starting to see again. Again, when we think about how to invest in this manner, and when we think about the political divide, we've got more than enough potential clients because, realistically, we're 50-50, if you will, politically divided. So we're going to continue doing what we're doing. Politics are really sort of an aside, other than what I said earlier about the being disingenuous. For anti-regulation politicians want to regulate not being able to invest with ESG metrics.
And all three of us actually live in these areas affected by climate change. I'm based in New Orleans, Asheville, South Florida. One of the things that struck me when I moved to Louisiana 15 years ago is you're typically hearing back then from those who lean towards the right side of the political spectrum, sort of a denialism. But in Louisiana, everyone could see the land loss that was there. And so are you seeing now that fires, floods, more weather events, is that driving more interest in sustainable investing because it's hitting home?
Go ahead.
I'd say yes, and somewhat the same. I'd say that those that wanted to invest still want to invest. I think we're seeing clients that are coming in and asking, how can I deploy capital in these areas that were just hit? And unfortunately, we can deploy capital. We can buy low-income mortgages. We can buy different type of investments. You have to wait for the cities to come out with climate change or capital bonds, usually through the municipal market, to say this is going to be, coral protection off the coast, or other things to set up to mitigate a lot of the potential damage that's to come, or to help rebuild after the damage has occurred. And that takes a little bit of time. So clients are asking. The problem is the market necessarily doesn't act as quickly because you need to get it through, you need to get budget, you need to get it approved, you need to then issue. At the same time, a lot of the rebuild that occurs is also waiting for insurance dollars. And there's a whole insurance problem that's going on in deploying, and reinsurance insurers that are walking away. So you're not necessarily seeing the quick opportunity to do that. You have to try to do it as a prevention at this point and get ahead and see the different opportunities that are being issued prior in order to help deploy capital. But right after it occurs, you can't necessarily deploy it as quickly as you would hope so.
Yeah, and I think, one of the things, I'm going to just go a little aside from what you asked, but we're so used to calling it climate change, and the reality is that we are now dealing with a changed climate. What we continued to put off into the future is now here, and we're just starting to feel the effects of it. And when we think about what our opportunities are, our cities are certainly going to start needing to raise more capital to strengthen our infrastructure, to harden our infrastructure. New Orleans did a lot of that post-Katrina. In fact, a couple weeks ago in Asheville, we had one of the people who was in charge of the rebuilding came and was telling us, okay, here's what we did and here's how we planned it out. And we were like, well, how did it go? He's like, well, we're still doing it. It's still happening, 20 years or so, after the event. And so we need to continue to take and look at this from a long-term perspective. How are we going to make this transition? Because, as we're sitting here, I can hear fossil fuel generators who are powering us right now. How can we move off of that? What are the opportunities for us to move off of that? And, that opportunity isn't going away. When we think about what is the definition of growth investing, the definition of growth investing is investing in where the economy is going. And I would argue that, no matter what politicians do, businesses are going to continue to do what is in their best interest, what is in their shareholders' best interest, and that is going to be to use less from an energy perspective, to become more energy efficient, and to really follow what a lot of their customers want, and that is to have a more sustainable product lineup, a more resilient, adaptive product lineup.
Yeah, I was really struck by this concept that in order to make shifts and innovation that is going to be needed, for example, to move away from fossil fuel to alternative energy sources, there's probably a million other themes that we could talk about with that transition, it's going to require a shift in capital. So can you talk about how this it is values-based, but it's also an opportunity for investing in the future, and also just what has to happen, right? So is this going to have to be bottom-up, client-driven? How are we going to actually be able to shift enough capital in time? Or will the chicken be there first or the egg?
I think if you look historically, this has always occurred. When you go from an agrarian society, right, people have to adapt. We have to make tractors. We have to put plows on horses. When you go to mining, right, they say, how do you make, in a gold rush, how do you make money through, you're selling the picks and the axes and the overalls, right? Well, as we move into climate change, or if we're in it already, capital's going to have to move because there's going to be opportunity. Everyone says, they look at Miami right now, most of it is below sea level. So if you have a rise in water level, they say Miami's going to go under. Well, they had the same issues in Venice and Amsterdam. What they do? They built canals. So that investment needs to occur. I think, how does it occur? I think you're going to see there's a lot of funds. I mean, the BlackRock's the larger asset allocators already. Larry Fink is saying that, hey, this is the next renewable energy and climate change investing in this next age is going to need capital, and there's opportunity to make money there. We've seen it from Tesla. We've seen others. Now, that's obviously a name that you probably want to stay away from right now. But the point is that the money is going to move because they're going to chase opportunity. And the opportunity is going to be there because it's going to be critical. And the question is, what are those specific opportunities? I think time is still out in terms of what's going to occur, but you're starting to see those solutions that are coming that are innovative enough, but you're still going to need government backing at some point. There's not enough capital right now to solve everything or move quickly enough, and that governments are going to have to come in and partner in a lot of these projects to really help move them forward efficiently in the future.
Yeah, I think so. And I think Henry Ford once said, if I had asked my customers what they want, they would have said a faster horse. And so, the public doesn't necessarily always know what they want. Steve Jobs also sort of subscribed to that same kind of idea that, the public doesn't know what they want until we tell them what they want. And so, having a leadership from a corporate side that's able to see the future, that isn't necessarily going to be influenced by politics, is very important. Despite the slowdown in EV adoption, you don't see that any of the major auto manufacturers are actually stopping their EV development. It might be slowed down some, but that's just sort of the idea of change, right? We admit that the only constant is change, but what do we resist more than anything? change. We don't want to change, even when it's in our best interest. And so, you're right that we are going to move forward. It would be nice to have some government support, and we have had that, especially during the last administration, from the IRA to the CHIPS Act, all those kinds of things. Really, we're moving progress and moving innovation forward. Innovation is going to be huge for us, to be able to mitigate a lot of the effects, to really help these next generations thrive. Ultimately, that's what this is about. This is not necessarily about doing good, but this is about making sure that we can invest smartly in a way that is going to help us innovate, so that way your kids and your kids, I don't have kids, are able to live the same level of life or greater than we have. Because if we continue on this changed climate path, it's not what we're going to want for them.
I think you hit on the main point when you're thinking of deploying capital and getting in return is, given change, what companies, what businesses, what investments are going to be able to adapt and continue to give you a return? If you look at Hilton, I believe the number, it took 100 years to get to 100,000 rooms. It took Airbnb 7 years to get to 100,000 rooms. So the speed of change isn't just that it happens, it's happening a lot more quickly. So businesses, one, have to be able to adapt to that. And two, you don't know what that change is. Is it AI? Is it climate? Is it other type of political? Is it tariffs? You don't know. And as you're looking to invest, as you're doing the fundamental research, regardless of if it's an equity, a bond, private credit, across the spectrum, you need to understand what is the viability of cash flow and what is the viability of that cash flow moving forward, so you can discount it back to find the correct price now. And is that of value? So you've got to factor these things, and historically, everyone did this. They didn't call it ESG, they didn't call it impact, they didn't call it anything. It wasn't a screening or not. They're just saying, is our product viable through the next environment of change? And unfortunately, what we're seeing now is through climate and through other pieces, that is a big component of change that is occurring, whether you believe it or not. We're seeing it. There were tornadoes that just went through Kansas in Tornado Alley. We saw the fires in California. These things are occurring. What businesses are going to be able to step up to either help solve for those problems, are going to be able to, no pun intended, weather the storm?
And like I said, ultimately, that's the definition of growth investing, is really trying to predict who are going to be the thought leaders going forward. So one thing that I'd like to point out too is that I think there's this impression that if you're going to invest sustainably, that you're going to be investing in solar and EVs and batteries and and maybe some wind, and that's about it. But you can really sort of broaden that, because there's a lot of other industries. When we put together our individual stock portfolio, the only sector that we do not have in that portfolio is energy, or the oil, the fossil fuel sector. Be aware that energy sector does not include solar or wind or alternative energy. Those typically fall under technology or industrials. But you can do everything from shoes that are sustainable to regenerative agriculture, real estate. How do we make buildings more efficient? A third of our emissions are still coming from the built environment. We talked about insurance. I think that the insurance industry has the opportunity to be the most influential industry when it comes to climate, because they're the ones who price the risk. And we are going to be running into an insurance crisis within the next decade because of things like Los Angeles, like you mentioned, because of Asheville, because of all of these impacts. And so, what are we going to see in cities that are high risk? Well, the only people who are going to be able to live in those high-risk areas are going to be people who are able to self-insure. And so I call it climate gentrification, because that's exactly what it is. People who have owned plots of land for generations, if a storm comes through and wipes them out, they're not going to be able to reinsure. They're not going to be able to rebuild. And the only ones who are going to be able to rebuild again are going to be the ones who can afford to. So insurance is an area, which insurers are the ones who are actually building climate risk into their underwriting processes. More are now, but for the last decade or more, it's been just the European insurers. Other areas that we want to look at are, like I said, the low-hanging fruit: batteries, alternative energy, EVs, not Tesla, and you can really build a core portfolio if you're really intentional about it, and you start from the ground up and you look for solutions providers, not just less bad companies that are better than the alternatives.
Yeah, I think you bring up a good point, and a lot of what this panel is supposed to do is how do you unlock that into client portfolios? And when you think about fixed income, some portion of your clients typically are going to have fixed income. As you go into an investment, not every single investment is one thing. And that's how we look at the world, where we can invest in an affordable housing property where we know that 90% of the building is helping low to moderate income individuals. But that building could be built with LEED certified materials. They could have resume writing workshops or offer discount childcare services to single mothers. And as you go through, you can document each component of impact that you're getting from one investment. At the same time, that same bond is going to be held in a BlackRock core portfolio. We're doing the same thing, but we're doing it intentionally, looking for that impact and driving capital specifically there because it's needed. One, there's not enough affordable housing use, but two, we can get more impact. So when you look at an entire portfolio, you could normally have it in your fixed income. Why wouldn't you go into a normal market rate portfolio where essentially you're getting it for free? You don't have to pay up. There's not a greenium or anything going on in the bond market, especially right now, around these types of assets. As we invest, we look at use of proceeds. So we need to understand dollar for dollar exactly every single bond that we're looking at, what type of impact is that bringing? And it can be multiple impact things. I think the last number we looked at was around 58% of investments have at least 2 impact themes. So as you go into different projects and you're evaluating different bonds and different asset classes, you're able to say, what is the totality of the impact that I'm bringing? But am I also getting that specific sector allocation that I want? And am I losing anything by that allocation? In reality, no, you're actually getting the same type of bonds, the exact same. If I look at my mortgage portfolio, agency mortgages, the index owns a third of it. We own a third if we could be a higher or lower if we want an over or underweight. But we're going into affordable mortgages. They're still Fannie Mae 3s. When they go into the market, they trade the same as a Fannie Mae 3 that's not an affordable mortgage. So the liquidity and all of those things that you would need in your portfolio to meet your clients' demands are being taken care of, but you're getting that same impact and you're getting it for free. And then we will give you what we think is the best in class impact reporting, so you can turn that over to your clients and they can see what they're doing. A lot of times we'll have pensions, we have other type of institutional investors that will take those reports, and at the board level they can see what they're doing. If they're a governor or they're running, they can say, look, here's what we're driving back to our communities, et cetera. If they're a corporation and we're using corporate capital, they can say, look, here's what we're doing in the communities that we operate and the positive benefits that we're having through our portfolio.
Yeah, so I think we've laid great groundwork for the opportunity. For advisors who are hearing from their clients and maybe don't offer any type of impact investing strategies and are looking to add it, or maybe those who are looking to improve, maybe after hearing about the pitfalls of screening, what advice do you have for undertaking that sort of a research project, is to find the right managers and the right solutions for clients?
I missed hearing the second part of that, but I think we're talking about advisors and working with clients on this.
How do they go about finding solutions?
Okay, yeah. First of all, we have to understand what the demographics are too. So, Morgan Stanley does a lot of research on interest and demand for sustainable investing, and based on their latest research, which came out at the beginning of this year, 95% of millennials are either somewhat or very interested in sustainable investing. 91% of Gen Xers have an interest, and 85% of Gen Z have an interest in sustainable investing. That's a tremendous amount of people who are going to be inheriting a lot of money over the next 20, 30, 40 years. So if you don't have a solution for that next gen, those folks are going to find somewhere else to go. They're going to go to me, they're going to go to some other advisor who does sustainable investing. And so as an investment advisor, first of all, you need to make sure that you're asking the question. Most advisors aren't asking whether their clients have an interest in sustainable investing or not because they might be afraid of the reaction they get. But in general, in my experience, you're going to know which clients are going to be open to it and which ones aren't. If it's that client when you visit their house and, sorry, but Fox News is on 100% of the time, you're probably not going to find a sustainable potential client there. You might, but odds are you're probably not going to, because that's just sort of a different political mindset. But the reality is based on those numbers, these next gen folks coming up, there is an interest there, and so you need to have an arrow in your quiver, if you will. So I'll make a pitch for myself real quick because I have a book coming out in October called The Sustainable Investor, and it basically helps advisors either transition their business over to a sustainable business, or it will help you try to figure out, okay, here's how I do it for those clients that do ask. We offer SMAs for the exact reason, because we don't want advisors to have to learn everything that we do. You manage your client, we'll be the expert in sustainable investing. So we try to license our portfolios that we've been running for, 15 years, 20 years to you, so you don't have to become experts. But at the end of the day, there's lots of resources. US SIF is Sustainable Investment Forum, is our trade group. They have got all kinds of training modules. Right now, the only certification you can get is a sustainable investing certification through CFA. There was one through College for Financial Planning, but they're dropping that. I'm not exactly sure why. But but there are opportunities for learning more and more about it. I don't know. What any thoughts you have?
No, I think you hit on a lot of it. I mean, the other thing is you come to events like this, and you listen to who's talking, and obviously find out opportunities. I think if you're affiliated with any of the larger brokerage firms, the Morgan Stanleys, they have platforms, and they're able to tell you, hey, this is what our model portfolio looks like. Here are the approved managers that we have on that list. Or you go back to the old school where you're looking through Morningstar and you're finding managers through the different platforms that are available. They have segments now. They differentiate out sustainable and impact and different type of managers. And at the end of the day, you're going to filter and you're going to look which are going to bring you the better returns and who are going to deliver genuine impact. And I think that's the other piece of where are we and why is there more capital flowing to you and to my firm over the last 2-3 years is we're out of that first inning of impact, and we're really in, I'd say, somewhere between the third to fifth inning. And it's no more, hey, we need to do this. It's we did it, but we're not really impressed with what we did. Where's the genuine impact? Who are the players that are really driving change and doing it in a meaningful way that is also focused on return and focused on our specific clients' needs? And it's really a lot of what's happening politically is there's a selection bias, because those that weren't truly intentional about it, or they were just trying to do an asset grab, they're falling away. And those that are left, right, when the water goes out, you see what's going, and before the water was coming in, and all tides, lift all boats. And now you're seeing the pretenders start to move away, and those that are really good at what they do, who are focused on what they do and intentional about it, are the ones that are really gaining assets. So as you go to look and who to deploy to, you're going to see that when you start to do that research.
Yeah, I think one of the most important things you can do is look and see what's under the hood. If you're looking at a fund that says it's sustainable or ESG or whatever, and you're seeing Exxon in there, if you're seeing McDonald's in there, you're seeing FanDuel, and I know I'm talking about a very specific fund, you might want to move on to the next one, because ultimately, if your client is asking you to be sustainable, they assume you're not going to be buying those kinds of companies in there. They assume you're going to be buying the solutions providers. And so, find the ones that actually have the solutions providers in them, because ultimately, again, doing this for 20-some years, that is what clients want. They don't want to be less bad. They want to feel like they're contributing.
I've been guilty of saying this, and I've heard other advisors say, if you want to have an impact, give to charity. But this type of investing actually allows one to hold on to their assets and earn a return from their investments and also make an impact. Can you just talk about how that could leverage additional dollars? And I love that trend, that thought of you could give it away, but you could also just use your balance sheet to make an impact as well.
No, I think that's huge. And historically, you've seen that at even foundations and endowments, where there's the grant-making side, and then there's the asset side. And instead of having just a liability by giving away, and there is a need and a demand, and that should occur, and I'm not saying take any of that away, but now if you turn your portfolio that's generating those returns that you're able to donate, you now have an asset that's also impactful. And that portion of your portfolio is much larger than the donation piece, typically, as you look at different studies and wealth creation and across the spectrum. What we're able to do is say, I can now take this portfolio, I can earn a return, I can take that return off that portfolio, and I can keep having impact, and that's sustainable. Where once you grant capital, you don't know, are you doing it just based on your income, and can your income change, and therefore, does the amount of impact you can have on society change? Potentially. Where if you put it into bonds, or you have a strong equity portfolio that's turning off X amount of dividends, you can deploy that capital every year and still have that asset base to continue to do that year on and year forward as you move through your life cycle.
I don't really have anything to add to that. You hit it.
Okay, we're down to the last few minutes. Is there anybody in the audience who wanted to ask a question? Yes. Okay, the question was, what is wrong with Tesla? Why are they not sustainable?
I'll jump in just from a 100,000-foot level. The actual car is sustainable. We are more just saying it's a political hot button because Elon Musk is overseeing Doge, and there's a big backlash right now. So it's kind of just, it's more of a hot button around the CEO and governance than necessarily the validation of their car and their technology.
Right. Well, I think that there's an investment merit too, because when you look at their sales in Europe have dropped off tremendously. Their sales in China have dropped off. I have a Tesla, and I'm turning it in August when my lease ends and getting a different brand. As a statement, I love my Tesla. It's the best car I've ever driven. But at the same time, I can't continue to support the CEO who is doing what he's doing. I will say that Tesla has had as much, if not more, of an impact than any company from a sustainability perspective, from their, from the solar side, from the battery side, from the adoption of EVs. It's all great. Plus their charging network, all is top notch. It's a distraction, and from a business perspective, he's been a distraction to the company, and ultimately sales are going to go down because of that distraction.
So I actually have investments that are the leases. So it's not actually, I don't own Tesla. I don't own the corporate debt. They take the leases from the finance company, they put them into a trust, and they issue debt off of that. And the merits of how those bonds play have nothing to do with the economics of the firm. It's solely those that believe in owning an EV, and we think that that's a sustainable investment, can go into the portfolio. We do have separately managed accounts where clients have said, hey, I don't want anything that has Tesla involved. I want it out of my portfolio. Others said, I get it, you're not owning the company. This is a bankruptcy remote trust that owns the economics of individuals' ability to pay their leases. We support it. So again, comes down to that values-based, right? Where, it might be split right here on the beach of what people think or don't think. There's nothing wrong or right? That's their opinion. What we're saying is you have the ability to express that in your portfolio, and we're not telling you what's right or wrong. We're telling you that we can optimize your portfolio to meet those values and those beliefs.
We have one more. Okay, the question was, what do you use for reporting and how do you measure impact? And we are down to the last 30 seconds.
So we use a software called Your Stake, And so your stake will basically take our portfolios or our potential portfolio. We can key that into there, and it's going to show us on, gosh, 50, 60 different metrics where it is relative to an index or where it is relative to another portfolio. It'll also show absolute impact as well from probably 15 or 20 different areas. Morningstar Direct also has some Sustainalytics data that we use to measure ours as well.
Yeah, quickly, I just say ours is all proprietary. We've been around for 25 years, so a lot of this didn't exist prior. So what we have built is really, we look at every single investment and we do a quantitative and a qualitative analysis. All of that goes into a database. So for every bond that we buy, there's a write-up, and we give those to our clients so they understand exactly both the quantitative metrics and the qualitative metrics to really understand the full story. And then whether it's on a fund, we'll issue a fund level impact report, and then we do a firm level impact report. And we were the first in the industry to actually do that, and now we see a lot of other firms that are mirroring that. So we love the old adage, imitation is the best form of flattery. So we think it's great because we think it's just causing everyone else to level up and say, what's the next standard of where we need to go in the future?
Well, Andy, Peter, thank you so much. This has been a very enlightening conversation, and we'll wrap it there. Thanks, everybody.